Your financial advisor is lying to you. They sold you a dream called diversification, a safe, prudent path to wealth. The responsible choice for responsible people. But what they've really given you is a one-way ticket to financial mediocrity. It's a system designed to make sure you never truly get ahead, but instead spend your life just keeping up. They've handed you a blueprint for becoming a permanent servant to the market, a passive passenger on a bus heading toward a destination called average. And let me tell you, average, after inflation and taxes take their cut, is a state of quiet desperation and slow financial decline. In this video, I'm going to prove to you that modern diversification, as it's sold to millions of hard-working people, is nothing short of slow financial suicide. It's a trap designed for mediocrity, a system that guarantees you will serve the market instead of commanding it to build real wealth. And most importantly, I'll show you how the truly wealthy build their fortunes by doing the exact opposite of what you've been told. Section 1. The Great Diversification Myth. So, what is this modern diversification that's become the unchallenged gospel of personal finance? For decades, it was the 60-40 portfolio, 60% in stocks for growth, 40% in bonds for safety. The idea was simple enough. When stocks went down, bonds would go up and cushion the blow. It was the financial equivalent of a seatbelt and an airbag. But in today's world, that 60-40 model has morphed into something way more insidious. Today, modern diversification means one thing above all else: index funds. Torrents of them. You're told to buy the S&P 500. Then, to be safer, you add an international index fund. Then a small cap index fund. Then an emerging markets fund. Then a bond index. Before you know it, your portfolio is a sprawling, messy collection of hundreds, if not thousands, of companies from all over the world. You end up owning a tiny slice of everything. The financial industry sells this as the peak of safety and sophistication. They call it a globally diversified portfolio. What they don't tell you is that you've just bought a guaranteed ticket to average. You have, in effect, become the market. Your performance will be the market's performance, minus the fees you pay for the privilege of tracking it. This whole ideology became dominant for a reason. After the dot-com bust in 2000 and the great financial crisis of 2008, investors were terrified. They were sold a story that picking individual stocks was just gambling and that the only sane response was to retreat into the warm, comforting hug of passive indexing. The financial world called this the democratization of investing. In reality, it was the institutionalization of mediocrity. And this brings us to the fundamental flaw of the entire philosophy. Modern diversification isn't designed to help you win. It's designed to prevent you from losing too badly. It's a philosophy of risk avoidance above all else, where the highest goal is to just not fall too far behind the pack. But here's the thing. When your goal is simply to not lose, you've already given up any chance of truly winning. Think of it this way. A diversified portfolio makes you a passenger on a very large, very crowded bus. The bus driver is the market itself. You have no say in the direction, the speed, or the destination. You're just along for the ride. You will arrive exactly where everyone else on the bus arrives, at the exact same time. The alternative, the mindset of a true investor, is to be in the driver's seat of your own vehicle. You choose the destination, financial freedom, and you chart the most direct course to get there. You're in command of your capital. The bus might feel safer, because you can't make a wrong turn, but it will never, ever take you to a destination of exceptional wealth. The legendary investor Peter Lynch, who ran the Magellan Fund to an incredible 29% average annual return for 13 years, had a name for this. He called it Diversification. It's the process of adding more and more investments to a portfolio, thinking you're making it safer, but you add so many that the portfolio becomes diluted. Its performance is doomed to just mimic the market average, all while you're adding complexity and cost. You think you're diversifying, but you're actually making things worse. You are diversifying. Section 2. The agitation how this myth bleeds you dry. Diversification isn't just a clever phrase. It's a financial cancer that slowly and methodically eats away at your wealth. It works in a few painful ways that the financial establishment rarely talks about. Let's pull back the curtain and see how this trap actually works. Pain point 1. The poison of dilution, selling your winners to buy more losers. Imagine your portfolio has just two things in it. Asset A is a high-growth company you've researched, you understand, and you truly believe in. Asset B is a broad market index fund you were told to buy for balance. Over a year, Asset A, your high-conviction pick, doubles. It goes up 100%. Asset B, the market index, just chugs along and returns a respectable 10%. At the end of the year, your financial advisor, or the rebalancing software in your account, tells you to take action. Your portfolio is now out of balance. Your winner has grown too large. The prudent thing to do, you're told, is to rebalance. This means you have to sell a piece of Asset A, your spectacular winner, and use that money to buy more of Asset B, the mediocre performer. Stop and think about how completely insane this is. In what other part of your life are you told to abandon what's working brilliantly to double down on what's just average? If you owned two businesses, one wildly profitable and the other barely breaking even, would you sell part of your successful business to pour more cash into the struggling one? Of course not. You'd do the opposite. You would starve the loser and feed the winner. Yet, in the world of modern investing, this backward logic is sold as wisdom. Rebalancing forces you to systematically cut your flowers and water your weeds. It's a mathematically guaranteed way to drag your overall returns down to the level of your worst assets. It punishes excellence and rewards mediocrity. This isn't just a theory. Studies show the benefits of diversification fall off a cliff after just a handful of assets, and that portfolios with 10 or more funds often underperform because the impact of any single winner gets completely drowned out. You own so much of everything that your best ideas are suffocated by the dead weight of everything else. Pain point 2. The illusion of safety. The house of cards in a hurricane. The central promise of diversification is safety. They tell you that by owning lots of different things, stocks, bonds, international stocks, real estate, you're protected because they won't all go down at once. This is the biggest lie of all. In calm times, when markets are just steadily climbing, this seems true. Different assets kind of do their own thing, and your portfolio chart looks nice and smooth. But that's a peacetime illusion. The moment a real crisis hits, a systemic shock like the 2008 crash or the 2020 pandemic, the game completely changes. In a true market panic, correlations all go to 1. What does that mean? It means everything goes down together. Stocks crash. Corporate bonds, which are really just another form of stock risk, also crash. Even assets that are supposed to be uncorrelated, like international stocks, also crash because a global crisis hits everyone. The hedge fails at the exact moment you need it most. The safety net you thought you had vanishes, and you're left holding a portfolio where everything is bleeding red. This illusion is made worse by something called hidden redundancy. You might think you're diversified because you own 5 different large-cap ETFs. But when you look under the hood, what do you actually own? You'll find all 5 funds have the same top 10 holdings: Apple, Microsoft, Amazon, Google, Nvidia. You don't own 5 different things. You own the same thing 5 times, and you're paying 5 sets of fees for it. This isn't diversification. It's a costume party where all your assets are wearing different masks but are fundamentally the same person. When that one theme, like large-cap US tech, gets hit, your entire, diversified, portfolio takes the punch. The 2022 market was a brutal lesson in this, as the classic 60/40ths portfolio got crushed because rising interest rates hammered both stocks and bonds at the same time. The hedge became a co-victim. Pain point 3. Guaranteed mediocrity, the mathematical trap of the average. This brings us to the most soul-crushing part of modern diversification, its guarantee of mediocre performance. When you buy an index fund, like one tracking the S&P 500, you are explicitly buying the average. You will get the average return of the 500 largest companies in America. You will never outperform. You will never have a fantastic result. You've signed up for a lifetime of being average. But it's worse than that. You don't even get the average market return. What you get is the average market return minus a series of relentless drags that slowly bleed you dry. First, you have fees. Index funds are sold as low cost, and while they're cheaper than old-school mutual funds, they're not zero. Those small fees, compounded over decades, add up to a huge chunk of your money moving from your pocket to Wall Street's. Second, there are taxes. Funds have to buy and sell stocks as companies move in and out of the index, or when they pay dividends. This can create capital gains that get passed on to you, the investor, and you have to pay taxes on them, even if you never sold a single share. This tax drag eats away at your returns. Third, and most devastatingly, is inflation. The single biggest risk to your future is the steady erosion of your purchasing power. Your goal isn't just to make your account number go up, it's to grow your wealth faster than the cost of living. Let's do some simple, brutal math. Let's say the historical average return of the stock market is 8%. From that, you subtract fees, let's say 0.1%. Then you subtract taxes, let's be generous and call it 1.5%. Your pre-inflation return is now 6.4%. Now, subtract the historical average inflation of around 3%. Your real return, the actual growth in your purchasing power, is a measly 3.4%. Think about that. You're taking on all the risk of the stock market, the gut-wrenching drops, the sleepless nights during a crash, for a 3.4% real gain. This is not a path to financial freedom. This is a treadmill. It's a system that might, if you're lucky, let you keep up with the rising cost of living, but it will never let you get ahead. For an average family already facing stagnant wages and rising costs for housing, healthcare, and education, a 3.4% real return is slow financial suicide. It's a quiet surrender to a future of just getting by. This is the trap. The financial industry has sold the middle class on a product that, by its very design, makes sure they stay in the middle class forever. It gives you the illusion of participating in the market's gains, while siphoning off just enough in fees, taxes, and inflation to guarantee that true wealth is always just out of reach. Section 3. The commander's mindset, the path to financial sovereignty. If modern diversification is a path to mediocrity, what's the alternative? It's a complete shift in how you look at your money. It's about moving from being a passive servant to the market to becoming an active commander of your capital. It's the conscious choice to stop accepting average and start demanding exceptional. This is the commander's mindset. This mindset isn't about gambling or being reckless. It's the exact opposite. It's about replacing the false safety of owning everything with the true safety that comes from deep knowledge and high conviction. It's about taking back your financial power and making smart, deliberate choices designed to build real, life-changing wealth. This approach stands on 3 core pillars. Pillar 1. Radical high conviction. The Buffett and Lynch playbook. The first pillar is the principle of high conviction, concentrated investing. Instead of owning a tiny, meaningless piece of 500 companies, you own significant stakes in a small number of businesses, maybe just 5 to 10, that you have researched like crazy and understand completely. This is the playbook of the world's greatest investors. Warren Buffett, probably the most successful investor ever, famously said, "Diversification is a protection against ignorance. It makes very little sense for those who know what they are doing." Think about what he's saying. Diversification isn't a strategy, it's a confession. It's admitting you don't know what you own, so you have to own a little of everything and just hope for the best. Buffett's partner, Charlie Munger, was even more blunt. Their philosophy, and the philosophy of greats like Peter Lynch, is that true wealth isn't built by owning 50 average companies. It's built by finding a few wonderful companies and betting big on them. Conviction is the key word. This has nothing to do with hot stock tips or chasing trends. Conviction is earned through hard work. It means you understand the company's business model. You understand its competitive advantages, its moat. You understand its management, its financial health, and where it's headed long term. You're not playing the stock market. You are becoming a part owner in a handful of excellent businesses. This concentration of your capital dramatically increases your potential for huge returns. If you own only 10 stocks and one of them becomes a 10-bagger, a stock that goes up tenfold, the impact on your portfolio is massive. If you own 500 stocks and one of them is a 10-bagger, the impact is a rounding error. Concentration allows your best ideas to actually move the needle on your net worth. It forces you to be disciplined, to do your homework, and to think like a business owner, not a collector of ticker symbols. Pillar 2. Engineering asymmetric opportunities, risking a little to win a lot. The second pillar of the commander's mindset is the relentless hunt for asymmetry. This is maybe the single biggest concept that separates the wealthy from the average investor. An asymmetric opportunity is an investment where the potential upside is exponentially greater than the potential downside. Think about the risk profile of a standard index fund. Your upside is capped at the market's average return. But your downside in a bad crash can be 30%, 40%, even 50%. You are taking on massive risk for a capped, mediocre reward. That is a terrible bet. Asymmetric investing flips this on its head. It's about finding situations where you risk a little for the chance to gain a lot. Your downside is known and capped, while your upside is huge, maybe even unlimited. The wealthy are masters at finding and exploiting these opportunities. So what do these look like? They come in many forms: venture capital and angel investing. When an angel investor puts $25,000 into a startup, the most they can lose is that $25,000. That's their capped downside. But if that startup becomes the next Google, their return isn't 10%, it's 100x, 1000x, or more. That is extreme asymmetry. Buying options. When you buy a call or put option, the most you can lose is the price you paid for that contract. It's a fixed, known risk. But if you're right and the stock makes a huge move, your profit can be many, many times your initial investment. It's a small, calculated bet on a big event. Intellectual property. Think about writing a book, creating an online course, or building a YouTube channel. Your initial investment is mostly your time. That's your capped downside. But the potential upside is a stream of income that could last for years with little extra work. Emerging asset classes. When assets like Bitcoin first showed up, a small, speculative investment meant the most you could lose was that initial investment. The potential upside, as we've all seen, turned out to be orders of magnitude greater. The key here isn't to bet your life savings on a single moonshot. The strategy is to take a part of your capital, the part you can afford to lose, and put it into a portfolio of these high asymmetry bets. Even if most of them fail, one single success can more than pay for all the losers and generate life-changing wealth. It's about intentionally engineering your financial life so that your winners can have a much greater impact than your losers. Pillar 3. Active participation versus passive surrender. The final pillar is a philosophical choice: active participation or passive surrender. The entire marketing machine for modern diversification is designed to convince you that investing is too complex, too dangerous, and too time-consuming for you to do it yourself. It wants you to surrender your power, hand over your money, and just passively accept whatever the market gives you. The commander's mindset is a total rejection of this learned helplessness. It's a declaration that you are the one most responsible for, and most capable of, managing your own financial destiny. Active participation doesn't mean you need to be a day trader, staring at flashing screens all day. It means you are an active learner, an active thinker, and an active allocator of your own money. It means you set aside time each week to read annual reports, industry news, books on business and investing. It means you learn the language of business, how to read a balance sheet, understand cash flow, and spot a competitive advantage. It means you're engaged with your investments, not as blinking symbols on a screen, but as ownership stakes in real businesses. This is the ultimate form of financial empowerment. When you're a passive index fund investor and a crisis hits, your only emotion is fear, because you have no control. When you are an active, high-conviction investor, you have a plan. You understand what you own and why you own it. A market downturn is no longer a reason to panic, it's an opportunity, a chance to buy more of the wonderful businesses you understand at a discount. This is the shift from being a market taker to a market maker in your own life. Yes, it requires more effort. It requires a commitment to learning. But the payoff isn't just the potential for much greater wealth, it's the freedom and sovereignty that come from taking command of your own financial future. Section 4. Your first step from servant to commander. The ideas we've just talked about are a huge shift from the conventional advice you've heard your whole life. And it can feel intimidating. The goal here isn't to have you liquidate your portfolio and go all in on a few stocks tomorrow. The goal is to simply begin the process of transformation. It starts not with drastic action, but with a change in your mindset and habits. Here are 3 simple steps you can take today to start your journey from market servant to capital commander. Action Step 1. The portfolio audit. Your first mission is to get radically clear on what you have. You can't command what you don't understand. For the next week, your only job is to audit your existing investments. Log into every 401k, every IRA, every brokerage account. If you own mutual funds or ETFs, don't just look at the name. Go to the fund's website and look up their top holdings. Print everything out. Your objective is to see the illusion of diversification in your own portfolio. Spread those papers out on your floor and grab a highlighter. How many of your different funds hold Apple? How many hold Microsoft? How many are basically just the same top 10 US tech stocks? You'll probably be shocked to discover how much overlap you have. You might think you own hundreds of things, but in reality, you may only have 1 or 2 major bets. You have to see the trap for yourself before you can start to dismantle it. Action Step 2. Build your watch list of conviction. The foundation of high-conviction investing is knowledge. So, your next step is to become a student. Forget about buying or selling anything for a moment. Your task is to create a watch list of conviction. Just identify 3 to 5 companies, not stocks, companies, that you find interesting. These should be businesses inside your circle of competence, as Warren Buffett would say. Maybe it's a software company whose product you use at work. Maybe it's a brand you love for its loyal customers. Maybe it's a medical company in a field you understand. Once you have your list, your work begins. Start reading. Go to their investor relations website and download their latest annual report. Don't be intimidated. Just skip to the business section in the CEO's letter to shareholders. Read it. What are their goals? Their challenges? Then, listen to their latest earnings call. You can find recordings on their website. How does the CEO talk about the business? What questions are the analysts asking? Your goal right now is not to decide if you should invest. Your goal is to slowly build a base of knowledge. That knowledge is the raw material you'll use to forge conviction. Action Step 3. Start thinking asymmetrically. The final step is to start training your brain to spot asymmetric opportunities all around you. This doesn't even have to involve the stock market at first. The goal is to just break free from the risk a lot to make a little mindset. Look for one small bet you can make in your own life where the downside is tiny and the potential upside is huge. Could you spend $50 to buy a domain name for a business idea you've had? Spend a weekend building a simple website to showcase a skill you have? Could you write and publish a short guide on a topic you're an expert in? The point of this exercise is to feel the power of a capped downside and an uncapped upside. The cost is small and known. The potential reward, while uncertain, is disproportionately large. By taking one small, tangible step, you start retraining your mind to see the world not as a place of risks to be avoided, but as a place of opportunities to be seized. This is the essence of the commander's mindset. The financial establishment has sold you a comfortable lie, that the path to wealth is paved with passive, timid, and endless diversification. They built a system that trades the potential for real wealth for the false comfort of mediocrity. They taught you to be a servant to the market, to accept average, and to surrender your financial destiny. Today, that ends. Stop being a servant. Start being a commander. The path to real wealth isn't found in the dilution of diversification, but in the deliberate, intelligent power of high conviction concentration. It's not about owning everything, it's about owning the right things. It's not about avoiding failure, it's about engineering asymmetric success. If you're ready to stop playing for average and start building real, generational wealth, subscribe to this channel for more videos on how to think and invest like a true commander of your capital. And now, I want to hear from you. Let me know in the comments, what's the single best investment you've ever made, and what made it a high conviction choice for you?